Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. I hope you enjoy this interview preview with Doug Eberhardt. So if you were asked to give a state of the market speech to U.S. investors going into 2017, what would your main points be? And that it can focus in the precious metals, or more broadly, is totally up to whatever you feel like you have the most to offer on or want to offer on.
Yeah, I'll give you both in a quick synopsis of both. For precious metals, I think we're in a little bit of a bull, obviously, right now. I do think we're going to kind of top out in that bull. I couldn't tell you exactly when, but I still, and this is what I wrote about in my book, the Illusions book, I still think we have that credit contraction, and the only reason it's been delayed a little bit is this Trump effect that we see going on, and the jury's out on that. I don't know what's going to happen with Trump when he gets in there. So far, the market's kind of liking him. The market did fail at 20,000 recently, and will it go above 20,000? I'm sure it will. So as far as the market goes, I'm leaning still a little bit bullish, although I think there's some trouble ahead, and the underlying trouble I don't think comes from the U.S. I think it comes from China and possibly Europe, and we'll see what happens there. But China, to me, has just got to go through their own deflationary contraction, and if that happens, if you remember not too long ago, the Dow dropped 1,000 points in a day just because China was having some issues. So China still is the key to everything, I think. But if it was just the U.S., we'd be off and running. So that's the way I look at it.
And so when you say credit contraction, could you kind of break down briefly what you mean by that?
Yeah, their banking system is kind of built on fluff, just as ours was in the 2009 era. And so they're doing a lot of things in their system that has no substance, let's say, behind it. And as long as you keep pumping money into the system and more loans are made, everything lasts a little bit longer. But sooner or later, the air is let out of the balloon and everything contracts. And that'll begin with the banking system, and just as it did with the U.S. And what will happen next is unknown. I mean, China's such a young bull in this whole picture of being being around with the Shanghai index. So it'll hit them harder, I think, than most people expect. I know people like Kyle Bass are in that camp, although they've been waiting and waiting and waiting for it. But I wrote about it. I gave my reasonings why in the Illusions book, and that's what I'm sticking with right now.
And you said if it was just the U.S., we'd be off the races. I guess you mean the equities markets?
Yeah, our data is not that bad overall. If people believe the data, that's one thing. I know the unemployment, the real unemployment rate, the U6, is still quite high, and there's a lot of people that say a lot of that growth in jobs is part-time jobs, so I understand that. But the overall data hasn't been that bad. I follow it every day, and so for the Dow to be where it is, I think it deserves to be where it is. However, it's something else, I think, outside of our own country that'll bring it down. The other thing is you have to go back to Reagan's era and what he did for the markets and the economy. He spent and spent and spent. I mean, everybody talks about Reagan being great as a president. Well, guess what? I mean, he was great, but he increased the national debt by quite a bit. And then here's the gist of it. George Bush, President Obama in 2008, when he was running for office, called George Bush unpatriotic for raising the debt $4 trillion. And during the Bush era, there was a war involved and whatnot. Well, Obama's raised it $9 trillion, and I don't know what you call him, but look at the stock market. Are people who are wealthy and in the stock market complaining? No.
Right.
But at some point, I mean, Trump's coming in, he's going to spend a trillion on infrastructure, and budget deficits are through the roof, and Obamacare is going to be replaced by something we don't even know what it'll cost, and so on and so forth. At some point, yes, something's going to happen, and this is what the gold bugs concentrate on. But when the dollar's going higher and higher, you just can't ignore that. So the key for gold buyers is going to be when the dollar falls below 100 and gold goes over 1,200. Those are your two key points right now.
So when the dollar falls below 100, okay. Right. So that's when this swing to being more bullish. Because I think I read on your site actually sometime in December that you mentioned, you weren't going to be surprised if in December and January, like December 16 and January of 17, that gold and silver could stay low, and like you mentioned a while ago, but could have a bullish trend for a good part of the year. But then at some point, some kind of a noteworthy deflationary contraction. That in your mind, that's when would really be the worthwhile time to, if you want to make some larger purchases of physical metals, that would be the time. And so that would be this deflationary contraction you're describing here, I guess.
Right. If we do go through a deflationary contraction, and not too many people write about deflation, most people talk about inflation, we'll have a scenario where it could take gold below 1,000. My ideal price is still 900 if we were to go that route. It doesn't mean that we're going that route, but that's if we were. And these contractions can be severe, and they can be quick. And they can gold can go lower than 900. I don't care. I want my all-in price to be 900 no matter what. And at that time, you just kind of go fishing, go to whatever is important to you in your life. And then in a year or two, you come back and you see where gold is, and it'll be much higher.
And again, from previous interviews, your longer-term expectations is that once this low is hit, that, and I'm maybe getting ahead of ourselves in the interview here, but that you do expect significant price appreciation in the gold and silver in coming years. And I guess once this deflationary event happens that you're describing, after that is when you expect and I don't want to use numbers, and I don't know if you use numbers because I don't want to get, out of hand with stuff, but I know that you've mentioned an extremely bullish approach, I think is a safe way to say it.
Right. The best way to put that is use what Richard Russell calls his third phase for the gold market, and his words were undreamed of heights. And so I am in that camp. I really don't give out numbers. I don't think there's a reason to.
Sure. I'm
not an options trader. I'm a short-term guy. But for long-term, most people who buy gold buy it as insurance, so they don't even care as much about its price as others do. And the same with silver. And the fact is, these metals hold their purchasing power, and that's why you have it in your portfolio. The price itself is somewhat irrelevant in that it'll still buy. If oil is 100 something a barrel, it'll still buy the same amount of oil today as it does when it's 100. So. That's what I look at is what will it buy you? What will it purchase you? Not exactly the price, but Richard Russell, I like his undreamed of heights comment. And that's what that third phase, when it hits, people aren't going to be talking about the stock market. They'll be talking about gold, kind of like tulips in a way.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.